I want to actually go through examples I think a lot of business owners face. The business just started. Business owner invested $50,000 into a business as a loan. The next thing is the business owner has stopped working, as in stopped PAYG, doesn't work for anyone anymore. But the year-to-date income they earned from the previous job was about $50,000. Business makes profit of $150K and expected to make profit up to June 2025 of $150K. We've got $150K profit for the business. We've got this individual earning $50,000 and we've got a loan that's in credit. So meaning that the company owes the individual $50,000. Should we pay the individual more money as a form of a wage, dividend, or loan? Dividends, there are a difference between unfranked and franked dividend. Franked means that there's tax that's been paid on that $150K. If you take that $150K out and put it into your name, the tax needs to be paid on that before the tax credit follows through to the individual. This is the part where a lot of people say you can get double tax. If you take that $150K out and then give it to this person here, they call it unfranked dividend, and it will get added here. It's going to be $150K added to here, and then your tax goes to 30%, and you're paying $60,000 on that $200K. But where did that $150K come from? It came from the company. So the problem with dividends is that in Australia, when you take up a dividend, it's not a tax deduction. You don't get a tax deduction where you can take off $150K here. You have to actually pay the taxes of 25%, which is here, and then you're left over with the net profit of that minus this, which is $112,000. Then you pay that $112,000 here. So pretend that this is the next year, so 2026. I take the profit of the company and leave it in the company, pay the tax of 25%. Then the next year, I'm allowed to take a dividend of $112,000. And that dividend is they call it fully franked, meaning that there's a credit that follows that dividend. And that credit is that $37,500 that you've paid in 2025. It's a bit confusing. It's just that the company needs to pay the taxes before you can actually get that credit. What does that do to your personal name? So in 2026, you can actually distribute that profit. This will go to zero because you've already paid the tax on it. Say you had made no profit in 2026, and you can actually pay yourself from the existing money that you're sitting in the bank account, and then your income will be 162. But there's one thing that's missing, which is the fully franked dividend. That 37,500 gets added to your taxable income, and that credit grosses up your dividend. So your income now becomes 200K, and your tax is 60, but you've got a franking credit of 37,500. The ATO adds these up, adds up the Medicare, and then reduces your total tax that you need to pay, and you only need to pay 12 grand. That's how you don't get double tax.